Hi, I'm Samir Jain, founder of ActiveAllocator, a digital asset allocation and portfolio construction fintech firm. I keep hearing that strategic asset allocation, how much to allocate to each asset class, is a boring, simple exercise. All you need to do is mean variance optimization and just get it out of the way. After all, hundreds of software packages and thousands of firms have been doing it for years. Nothing can be further from the truth. We spent 3 years building the planet's #1 asset allocation methodology, and we did it for a reason. Getting strategic asset allocation right explains over 80% of long-term variance in returns. It is the only thing that matters. I'm going to dispel with popular myths and demonstrate that all asset allocation is not the same. I will give you not 1, not 2, not 10, but over 20 reasons why we are different and better. Let's start with prevalent wisdom. Prevalent wisdom accepts that historic returns and risks are observable and are measured comparably and accurately across all asset classes. The reality is market prices, hence returns, volatility of returns, and risks for many instruments, especially thinly traded and illiquid investments, are observable only with a lag. So our proprietary algorithms, unlike what others do, utilize observable data to generate true underlying risks. Others assume that returns are accurate and largely marked to market. Typically, assets are continuously traded on exchanges and are highly liquid. We have the New York Stock Exchange not too far behind me. But returns for many strategies are not marked to market daily, understating true risk. Our algorithms correct returns data to assess adjusted long-term statistical properties. Everyone presumes, incorrectly so, that historic returns are independent and identically distributed over time. The past period's return does not influence the current period's return. However, serial correlation, which occurs when returns are interdependent as opposed to being independent across time, reduces volatility and artificially increases risk-adjusted returns, the Sharpe ratio, making some asset classes appear relatively more attractive. It also alters correlation between asset classes. So we unsmooth return series using autoregression and other techniques to correct for serial correlation. There is this widespread belief, and it is that return forecasts are reasonable and accurate. However, return forecasts are subject to idiosyncrasy given manager skill, and they are often inconsistently integrated across asset classes. So we utilize street consensus estimates and spreads, which tend to be more stable over time. We also empower users to express their own investment views to individualize client advice. People also make simplistic assumptions that the covariance matrix is stationary. However, the reality is correlations between asset classes are in a state of continuous change, particularly in times of market stress. Correlations frequently rise and they converge. So we utilize a dynamic near real-time covariance matrix. Folks make a faulty assumption that fund managers operate in inefficient public markets, I beg your pardon. That markets are efficient, that new information is priced immediately. However, active managers often operate in both efficient and inefficient markets. Active managers seek restricted markets to exploit inefficiencies. Our algorithms differentiate expensive market exposure or beta from prized skills or alpha. We distinguish between market exposure and manager skill to implement portfolios that fulfill the strategic asset allocation. Nearly everyone I know offers a very oversimplified investable universe, typically 10, 15 or fewer asset subclasses. However, the investable universe is much more diverse, and there is value to precisely classifying investment types and styles. We offer over 50 subclasses to choose from as our proprietary algorithms reduce estimation errors. Folks accept that there is a fair degree of homogeneity between sub-asset classes. We believe that there is greater heterogeneity in sub-strategies. So we account for specific characteristics of each subclass in our optimization. For example, strategies that demonstrate higher predictive statistical homogeneity in returns are grouped into baskets to attenuate the pernicious effects of style drift. Other systems assume that investors and fund managers possess comparable information on underlying investments. Truth is, there is asymmetric information. Fund managers know more than their investors do. So our forthcoming portfolio construction technology utilizes a probabilistic Bayesian construct with assigned confidence levels to overcome this information asymmetry. Everyone knows that liquidity and asset classes are dissimilar. Many investments contain significant degrees of structural illiquidity or tradability restrictions that limit one's ability to rebalance. Yet nobody has been able to solve this problem. So our optimization method extracts a dynamic illiquidity premia to compensate for how far and for how long an illiquid portfolio is from a theoretical efficient frontier. Now, when it comes to hedge funds, folks are obsessed with historical returns and operational due diligence. They assume that there is no selection bias in historical returns time series. However, a selection bias exists when databases incorporate the performance of only those managers who choose to report, and managers who perform better are typically more likely to report, creating an upward bias in an index. We utilize databases and indices that are designed to filter out bias, and we incorporate a bunch of statistical methods to further reduce bias. Others also make the flawed assumption that there is no short history bias at asset class levels. But short history bias exists at the manager level, where shorter history may not accurately reflect longer term returns. So we assign probabilities to historical returns and probability weights to predicted versus realized. Another big flaw is treating that there is no survivorship biases in indices data, but managers may cease reporting, typically due to poor performance, resulting in an overestimation of returns. So what we do is we filter out bias and use statistical methods to further reduce bias. When investing in funds with lockups, people assume that there is no strategy drift. However, strategies and funds are subject to incorrect classification over time, leading to bias and misestimation of true risk. We aggregate strategies into more stable units to correct for drift and bias. Another thing is everyone believes that volatility accurately reflects risk, and investors only worry about variance of returns. This is not true. Volatility is just one measure of risk, and it often understates true risk. Historic returns are often negatively skewed and may exhibit fat tails or excess kurtosis. Extreme event tail risk is difficult to quantify, and time series returns, as I said, may be negative with a positive skew and fat tails in distribution, which implies that the probability of an unfavorable deviation from the mean is higher than the normal distribution that we were used to in high school. Volatility also understates sporadic downside risk, which investors care about. So our algorithms optimize for negative skew and kurtosis effects and incorporate extreme, though rare, downside events as well as drawdown periods. Another big flaw is volatility is calculated over long periods of time and people use average historical volatility. However, volatility is time variant and continuously changing. So we account for dynamic volatility, including special issues such as volatility clustering, where large or small changes follow large or small changes. Another flaw is the way people think about market beta. They calculate market factor exposure, beta over long periods. But the reality is, beta to markets is time variant and continuously changing. So we utilize the Kalman filter and other sophisticated approaches from signal theory to calculate time varying beta. Also, to make things simple, people utilize hard-coded portfolio construction constraints to curtail complexity. And what this does is it creates concentrated portfolios. We offer flexibility to change portfolio constraints on the fly, such as limits on individual asset class exposure, limits on groups of asset classes, and also our optimization considerations then include minimizing maximum drawdowns, long-term beta effects, the distribution of returns, average loss, worst period returns across varying market cycles. Building off dated modern portfolio theory, most methods assume that investors have a quadratic utility function and can be lumped into coarse-grained categories that is gleaned from static client portfolio questionnaires. We believe each investor is unique and investor circumstances may change suddenly. We therefore create bespoke portfolios, mass customization, personalization, and a portfolio of one. Since often clients don't know any better, and all that I'm describing here is very, very hard to design, code, and implement, the general simplified approach suggests that investors invest passively at the broad asset class level using inexpensive indices. However, that's not the answer. Solving for complexities of alternative investments and active management techniques and purposively including them into the portfolio construction process can be beneficial. So what we do is we synthesize market fundamentals, manager skills, illiquidity premium, downside risk management to optimize expected returns. I could go on and on and on, but I hope you're beginning to get some sense of how different and how sophisticated our approach is. So all asset allocation is not the same, and I encourage you to check us out on ActiveAllocator.com, take a test drive, and if you like what you see, do get in touch with me. And thanks for listening in. Bye-bye.